Good afternoon. Today we are also joined by a group of young women with the ambition of taking my job one day. They are winners of the MPC Schools Challenge for 2019. Let's get on to the business. Since the July meeting of the Monetary Policy Committee, economic indicators confirm weaker global economic conditions and low inflation. Central banks in advanced economies have provided more monetary accommodation, helping to ease global financial conditions. Downside risks from escalating trade and geopolitical tensions remain pronounced. In the second quarter of this year, South Africa's GDP rebounded from the contraction experienced in the first quarter, but economic activity levels still remain weak. Monthly inflation has been around the midpoint of the inflation target range, as food and services inflation remained subdued. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, was 4.3% in August. Goods price inflation in August was 3.9%, while services price inflation remained at 4.7%. Food price inflation rose to 3.9% due to rising cereal and bread prices. The bank's measure of core inflation, which excludes food, fuel, and electricity, rose slightly to 4.3%. Producer price inflation for final manufactured goods decreased to 4.9% in July. The medium-term inflation outlook is largely unchanged. The inflation forecast generated by the SARB's quarterly projection model is for headline inflation to average 4.2% in 2019. The projection for 2020 is unchanged at 5.1%, and for 2021 slightly up to 4.7%. Headline CPI inflation is expected to peak at 5.3% in the first quarter of 2020 and settle at 4.5% in the last quarter of 2021. The forecast for core inflation is lower at 4.3% in 2019, is unchanged at 4.7% in 2020, and is slightly higher at 4.6% in 2021. Electricity, food and fuel price inflation continue to shape the near and medium-term trajectory of headline inflation. Fuel price inflation is expected to average 2.4% in 2019 and to peak at 11.8% in the first quarter of 2020. While food price inflation has generally surprised on the downside, it is expected to peak at about 6% in the third quarter of 2020. Electricity prices came out higher than expected in August at 11.8%, but remain in line with the forecast. Inflation expectations have continued to moderate gradually. According to the Bureau for Economic Research third quarter survey, expectations for headline inflation are down slightly for 2019 to 4.6%. Expectations for 2020 remain unchanged at 5% and eased from 5.2% to 5.1% for 2021, reaching the lowest levels since 2007. 5-year ahead inflation expectations also declined to 5%. The inflation expectations for market analysts in the September 2019 Reuters Econometer survey have been revised lower to 4.3% for 2019 and remain unchanged at 4.9% and 4.8% in 2020 and 2021 respectively. Market-based expectations implicit in the break-even inflation rate, that is the yield differential between conventional and inflation-linked bonds, have remained stable since the previous MPC. 5-year break-even rates are currently about 4.6% and 10-year break-even rates at 5.4%. Global GDP is expected to slow to 3.2% in 2019 and rise to around 3.5% in 2020. While global growth remains resilient, recent indicators on trade and manufacturing have deteriorated and a range of downside risks to growth remain. Growth in world trade volumes has continued to decline, with trade tensions weighing on market confidence and lowering investment. Other downside risks include geopolitical developments, further oil price shocks, and high levels of corporate and sovereign debt. Across most countries, there is limited policy space to respond to shocks. Inflation outcomes and inflation expectations in most advanced economies remain below targeted levels. Barring significant shocks, monetary policy in major advanced economies will remain accommodative over the medium term. However, market expectations of further accommodation appear high, creating ongoing risk of market volatility should these not materialize. Since the July MPC, the rand has depreciated by 4.6% against the US dollar and by 3% against the euro. The implied starting point for the rand is 14 rands 88 cents against the US dollar, compared with 14 rands 40 cents at the time of the previous meeting. At these levels, the QPM assesses the rand to remain slightly undervalued. While the rand has benefited from improvements in global sentiment, investors remain concerned about domestic growth prospects and fiscal risks. GDP rebounded to 3.1% in the second quarter, following a decline of 3.1% in the first quarter. The sharp quarterly rebound was caused by stronger output in nearly all sectors, including investment and government consumption spending. However, longer-term weakness in most sectors remains a serious concern. Based on recent short-term economic indicators for mining and manufacturing sectors, the third quarter GDP outcome is expected to be muted. Business confidence has declined further. The ABSA Purchasing Managers Index came out at 45.7 points in August, and the RMB BER Business Confidence Index fell to 21 points. The SARB's Composite Leading Business Cycle Indicator also continued to trend lower, although the coincident indicator remains positive. The forecast of GDP growth for 2019 remains unchanged at 0.6%. The forecasts for 2020 and 2021 have decreased to 1.5% and 1.8% respectively due to revisions to global growth and domestic potential growth. The MPC assesses the risk to the growth forecast to be balanced in the near term, but remains concerned about medium-term growth and weak employment prospects. Escalation in global trade tensions, further domestic supply constraints, and/or sustained higher oil prices could generate headwinds to growth. Public sector financing remain high. Public sector financing needs remain high, exerting pressure on the currency and pushing local bond yields higher relative to country peers. Implementation of prudent macroeconomic policies and structural reforms that lower costs and raise investment and potential growth remains urgent. The overall risks to the inflation outlook are assessed to be largely balanced. Demand-side pressures remain subdued, and food, wages, and rental prices are expected to increase at moderate rates. Global inflation should remain low. In the absence of shocks, relative exchange rate stability is expected to continue. Some upside risks to the inflation outlook remain, in particular from fuel, electricity, and water prices. The MPC welcomes the sustained moderation in inflation outcomes and the fall in inflation expectations of about 1% since 2016. The committee would like to see inflation expectations also anchored closer to the midpoint of the inflation target range on a sustained basis. Against this backdrop, the MPC unanimously decided to keep the repurchase rate unchanged at 6.5% per annum. Monetary policy actions will continue to focus on anchoring inflation expectations near the midpoint of the inflation target range in the interest of balanced and sustainable growth. In this persistently uncertain environment, future policy decisions will continue to be highly data dependent, sensitive to the assessment of the balance of risks to the outlook, and will seek to look through temporary price shocks. The implied path of policy rates over the forecast period generated by the quarterly projection model indicated no changes to the repo rate. This remains a broad policy guideline which could change in either direction from meeting to meeting in response to new developments and changing data and risks. That concludes the statement, and as usual, I would open the floor for questions, and please identify yourself and the name of the media house that you represent, and we will deal with your questions. Amokela.
Good afternoon, Governor. I'm Khelang Bata from Bloomberg News. Governor, in the context of the attacks that we saw in the Saudi oil refinery over the weekend, does the bank's forecasts for oil prices factor the risks emanating from that particular attack, particularly when you think of the supply disruptions that we could see and oil price shocks, particularly in the context that we see that you have cut your oil price forecasts for the next 2 years? So do those factor in any shocks or disruptions that may impact the oil price?
Yes, ma'am.
Governor, it's Pranesha from Bloomberg. In their previews, many economists predicted that the SARB would keep the rate unchanged due to concerns about fiscal risks and also the threat of a Moody's downgrade. Did those factor into your discussions at all, and to what extent? Thank you.
Is that it? No other? Okay. Amakela, the forecast that we table was done last week. That was before the attack, so it doesn't factor those things in. But be that as it may, when you have the attack, the question is always going to be how quickly can production be restored, and that will have an effect on the price going forward. But our approach when these kinds of events happen is to assess, is this a once-off shock, and could we see through that? And that's exactly what we do. We look at the thing, and if we find that it was a once-off shock, we look through it and see whether it changes the outlook. If it does, then there might be a need to adjust a policy to deal with those kinds of shocks, whether they are positive or negative. Pinesha, fiscal risks and possible Moody's downgrade, those are always at the back of our mind. They are unknowns. So it's difficult to factor them into anything that we do because we do not know what they would be. Moody's will be doing its visit or making its decision sometime in November, and when that comes, we will deal with it then. It's a question of, if it is a downgrade, is that downgrade in current prices or not? If it is in current prices, it should not have an effect. But if it is not in current prices, you should expect that there would be outflows of capital, and that will manifest itself in the exchange rate. And the way we think about it is that it's a shock. We do not respond to shocks in that manner. We would then look as to whether second round effects kick in. If second round effects kick in, then we would respond to those second round effects rather than to the first round shock. Any other questions? Anybody there on the line?
Yes, Governor. Razia from Standard Charters. With the MPC remaining data dependent, what might raise the risk of renewed easing? Would it be correct to rule out any easing unless inflation expectations move towards 4.5?
Is that it?
That's
Thank you
it
very
from
much. Any other questions from the House? Okay. Razia, let's turn this thing this way and say that the focus of policy is on what we are tasked with, which is to keep inflation within the target. And in our case, we say that we would like to see it closer to the midpoint and inflation expectations anchored to the midpoint. We are data dependent. Yesterday's inflation means nothing for future policy, because that is yesterday's inflation. The focus that we have is what is the outlook for inflation going forward, and that is what we respond to. So the data that comes through should be telling us what we think would happen to future inflation, and if there are changes to the future inflation based on that data, policy will be adjusted accordingly. Lucanio.
Hi, Governor. Governor, considering that your counterparts elsewhere have been loosening policy, aren't you concerned that this may put upward pressure on the currency, possibly damaging the second half of your mandate, which is to support growth? And I note that you've actually downgraded your longer-term growth focus for 2020 and 2021.
I don't know whether I should say that our colleagues in other parts of the country followed us in August. If you ask them, they will tell us you they didn't. And neither do we follow them when they do things. We are a small open economy. Developments in the advanced economies do affect us. They affect us through two channels. Firstly, the trade channel, and secondly, through the financial channel. And at the moment, we get affected mainly through the financial channel. And what is important for us is that when those changes take place elsewhere, we have got to then ask ourselves, what would be the impact on the South African economy? So our response would be what the impact is on the South African economy of any of the developments from the other countries, mainly the developed economies. The outlook for the currency is a complex matter. And it used to be that in the past, the currency could just be driven by what central banks do with policy rates. But in today's more integrated economy, there are so many moving parts that would affect a currency. And in our case, the currency has tended to actually be more responsive to the movements in capital flows, and those capital flows could be equity, or they could be bonds, or both. And the important thing here is that the behavior of those two categories of portfolio flows vary. Equities tend to respond to the changes in the growth outlook, whereas bonds would respond to changes in the inflation outlook, because the changes in the inflation outlook tells them what is likely to happen with future movement of interest rates. So cut a long story short is that we do not see pressure on the exchange rate just because our colleagues elsewhere had moved and had cut rates. They face different circumstances. The US had cut rates because they are trying very hard to generate inflation. That is not the problem we have in South Africa. So we keep on comparing ourselves to countries which have got a low inflation problem. Our problem is not that we have got low inflation, and so we get assessed differently. Well, in the absence of any further questions, Sianda, you also want to ask a question?
Governor, 3. Peter Montalto from Interlit. Governor, can you please talk a little to the likelihood of structural reforms, particularly in light of the Tito paper, and if reforms don't come, does the central bank have to take a different view on rates higher or lower?
Yeah.
Michael Potgieter from ETM Analytics. 2 questions for the governor. Has the bank assessed to what degree is the government's high financing requirements crowding out credit extension to the private sector? And is the bank concerned that we see offshore investors offloading SA government bonds further? If so, what scenario planning is taking place around this? Andrew Matteni from BER. Governor, it seems to be very dovish statement, yet unanimous, for no change in the repo rate. This seems to be large shift from unanimous of a 25 basis point cut in July. Can the governor help to explain this? Last one, Governor.
You said 3.
This is the last one. To what degree do you assess that a downgrade from Moody's is priced into the market?
I've dealt with that one, so there is no need. Yes. Thank you very much. The likelihood of structural reforms, it is good that such a discussion is taking place, but it's the other guys down the road who must deal with structural reform. We have been raising these things for a long time, that we need the structural reform to lift the potential growth rate of the economy, and we are glad that finally government is talking about those structural reforms. Relationship between structural reforms and rates, it is not that apparent what the relationship would be, because monetary policy reacts to cyclical factors rather than the long-term structural issues. And Michael had a question about government financing requirement and whether it is crowding out private investment. Too early to tell. We do not have that information or any evidence that there is a crowding out. And the crowding out most of the time also works in a closed economy. We have got an open capital account where you have got participation by foreign players in our bond market to the extent of around 36% of government's debt being held by foreigners. So there is access to capital flows from elsewhere. So we can access foreign savings through that mechanism. So. Yeah, let me leave it there. And then the thing about offshore investors coming out, I think that it is in the same manner that I dealt with the question earlier. It's a function of whether we are downgraded or not. It's a function of whether the downgrade has been priced in or not. And at the moment, none of us can give you definitively whether the thing is priced in or not. Okay. Ma'am.
My learners want to ask questions.
Yes, I just wanted to make sure that the adults are done. Lucanio.
So, hi, Governor. So I was just slightly intrigued with how the QPM works, because last time, it was implying a cut before the end of the year. But based on your statement, things are broadly much balanced, if unchanged. But the QPM has changed. I'm just wondering what has caused that to change, because it doesn't seem like it's your inflation forecast has changed or anything else has changed.
Okay. No, it's an easy one. The QPM said that we must cut rates in the fourth quarter of this year. We decided to do it in July. So once you have done it, the QPM will say, okay, it's done. So because it's done, there is no need, and that is why it remains flat. Okay. So that was the thing. Thank you very much. And my dear learners, you have got a question. Oh, the adults are competing with you.
Sorry, Governor, it's just a follow-up on Lucanio's question. Does that mean that a rate cut is ruled out for the rest of the year?
Like we said, the QPM is a guide. When you come to the next meeting in November, and we have considered all the data, and we have forecast our inflation and GDP figures, you will know for sure what we are doing for the rest of the year. Okay, thank you very much. My learners, you want to ask me privately, you don't want to ask here? I'm sure you can ask.
I would like to know, what was the impact of the escalating trade tensions between the US and China on the decision? And if the trade tensions continue to escalate, what will be the impact on your next decision?
Good question. I can see the adults being jealous. They wish they asked that question. Yes, ma'am.
Considering the weak employment prospects, as you have mentioned, and unemployment currently sitting at 29%, and I know that your mandate is to solely curb inflation, but we can't ignore this factor. How do you think the now repo rate that you have released, how do you think it's going to curb the high unemployment that we are currently facing in South Africa?
Okay, thank you.
Oh, Governor, sorry, to add on what my learners are asking, I'm Ms. Rapanyani from Midrand High. So I need to ask, with the recent unrest and xenophobia allegations, are we not supposed to be worried with the effect it will have in the economy?
Thank you very much. Trade tensions. In a trade war, there can't be winners. We can only all be losers. And in this case, the loser is the global economy. South Africa is part of that global economy. We are small, and what we have seen is that these global trade tensions actually dampen global demand, and they actually lead to slower world growth. And one of the factors that we actually put in as to our revision of growth going forward has to do with the fact that we expect that global growth will be slowing down. So that is how that channel works. We produce stuff here that we sell in the global market, and if the global economy slows down, it means that the appetite for us to sell our goods into that global market is actually adversely affected. Employment, you know that employment is an outcome of growth. So if you want employment, you're going to have to generate growth. Absent growth, you cannot have rising employment. And so you said that our mandate is to solely look at inflation. No, actually, the Constitution says we do this thing in the interest of balanced and sustainable growth. So we constantly have to watch what is happening with employment trends, because they matter on what is going to be happening to inflation also going forward. So our stance, monetary policy, affects cyclical growth. It doesn't change the long-term trend. And if you had the question that was asked about what are called structural reforms, that is what you need to change to lift the potential growth rate of the economy. And if you make the necessary changes and growth goes up, that is where employment is going to come from. What monetary policy does is that it affects growth around that long-term growth potential of the economy. The attacks, we didn't discuss these attacks, and it's difficult to assess what they actually mean. All that we could say is that anything that disrupts economic activity in such a weak environment will not be good for the business environment. And but to what extent would it have affected economic activity? It is something that we cannot have our finger on. Yeah, let me leave it there. Thank you very much. That concludes the business of today. I will see you same place in November.